in the real estate world, you've probably heard about opportunity zones or opportunity zone fund investing, but a lot of people don't actually know what this means or how it works. So I want to tell you a little bit about how it works and if it might be a strategy that you can take advantage of. Hi, I'm Maura. I am a full-time real estate investor and I help people build and scale their real estate portfolios. And today we're going to talk about how opportunity zone investing works. So in the 2017 Tax Cuts and Jobs Act, the U.S. government, in conjunction with state governments, identified areas across the nation that they wanted to help incentivize growth and economic development in, and they called these opportunity zones. So in every state, there are several opportunity zones. If you go and search your state, you can probably find a map that shows you where your opportunity zones are. So what's unique about opportunity zone fund investing is that it's a way to defer capital gains from any type of investment, not just real estate. So for example, if you exercise stock options, sell your stock, sell crypto, or any type of asset, and you are wanting to offset some of the capital gains from selling that investment, an opportunity zone fund investment might be a good option for you. So if you invest the capital gains from the sale of another type of investment into an opportunity zone fund. So to invest in an opportunity zone, you have to do it through an opportunity zone fund. So this is something that would be set up by real estate investors through an LLC, a partnership, or a corporation. And they have to file certain paperwork with the IRS and abide by certain regulations for this type of fund. So you have to find a fund to invest in, and then you invest your funds. Basically, the fund has to materially improve their investment within 30 days of purchasing it, basically providing that kind of improvement or economic stimulus into the area. And then as the investor, if you leave your investment in the fund for 5 years, you are subject to a 10% exclusion. If you leave it in for 7 years, you're subject to a 15% tax exclusion. And if you leave it in for 10 years, you don't have to pay any capital gains. So for example, if I sold a bunch of stock and I had maybe a $20,000 capital gains tax bill, I could put that in an opportunity zone fund, leave it for 10 years, and then I wouldn't have to pay that tax liability. So that's just an option that's out there for you, a little bit more of an advanced tax strategy, but one that could be very useful if you're looking for a way to offset a big tax liability.